Remember, mister, if I tell you, go on site.
Oh, yes, Grandma. I know. Jeez. Hello? Hi, good afternoon. I'm calling in regards to a delinquent account under the name of Katura Daily. Would you mind if I speak to her, please?
Hello? You still there, son?
In regards to my great-grandmother, she's not here at the moment. No, sorry, that's not what I meant, sir.
So what exactly do you mean by what you just said?
My grandmother's passed away. What's up, my beautiful YouTube community? And I first want to start the video by thanking the beautiful people who gave me this shirt from truelove.apparel. Jackie and your brother Jerry. He does custom shoes as well, and those are really cool. I'm gonna leave the link to his channel in my bio or in the description. I think that's what it's called. But back onto the video. That took about 30 seconds, sorry. Today we're going to be doing episode 3 of Millennial Money Management, and we're going to be talking about, as you saw in the skit, credit. Okay? Credit.
Talking about practice. I mean, listen, we talking about practice.
Very important. If you saw Millennial Money Management episode 2, you know this was going to start off at debt, and we were going to loop over into credit. So let's get it. First things first, when it comes to credit, we're going to talk about the things that build your credit. The number one thing, and what used to be probably the worst thing for building your credit, is a cell phone. I got 2 phones. For many years in Canada, kids were getting literally bad credit accounts because of cell phones. Very dark time in a lot of our lives. I still know people to date that have outstanding cell phone debts. I knew one person who consistently went into debt for cell phones, whether it be a bill or breaking a phone and then taking a phone basically on cosign through the not the credit company, the telephone company. Now, how can a cell phone make or break your credit? Number one, you sign a contract. Number two, that contract is legally binded to your credit bureau, technically. So if you do not make payments on the phone, they will send a bad credit report to your bureau. Very unfortunate. A phone can also build your credit, okay? They do not report as often as a car finance, and we're going to get into that soon, and a credit card or a line of credit, but they still do a report. From my understanding, the phone company reports the least out of all the places that would be reporting to your bureau. Hence why we're touching topic on it first. Generally, it changes among phone companies, but I'm pretty sure they all like to keep the same rule of thumb and only report twice a year. Now, why I think a cell phone on a plan with a company who's going to report to a bureau is in your best interest now is because prior to 2013, I wouldn't have recommended this, because phone companies were basically robbing people blind for a very long time, overcharging people on data, roaming charges, and sometimes even random expenses that would show up on your bill that people were just unaware of, and just having their credit card being charged. Okay, as of 2013, there was an act put in place that restricted the phone company from doing a lot of things, and we're going to go down a small list of how the act helped us to now be able to hold a phone and not worry about basically running up a bill that's we're not going to be able to pay at some point. All right, so I got my handy dandy iPad here with a few notes, and what the act consisted of was unlocked cell phones were mandatory. All right, there had to have been a trial period for each phone company to ensure that people have enough time to sit with the phone and opt out of the contract if they wanted to. So usually if you walked up to the counter and signed that contract right away, you were basically binded to that cell phone with no trial period. That was a very, very good thing they added. The only other thing that I can say really helped in the act was the data overage charges and the roaming charges. A lot of people were getting into bad phone bills or delinquent phone bills. Why? Because of the data overage. We all know how the internet runs the world nowadays, and this was a crucial part in the phone companies basically milking your pocket dry. A cell phone now, though, I think is a good way of slowly building your credit. Just don't go out and take out a phone, basically a phone plan that's going to charge you an arm and a leg. I personally don't like phone companies, and I rather have technically a pay-as-you-go. So a phone that's just going to get cut off if I hit a certain cap. The good thing about this new act as well is that your bill is capped when it comes to overages. So they cannot continue to charge you even though you're not using the phone. Another issue a lot of Canadian, especially students, ran into when it came to cell phone companies in more, I guess, prior years. The next thing we're going to touch topic on is credit, cards, and lines of credit. There's a difference between the two. A credit card does one thing, a line of credit does another. Each has its own perks. Each is for a certain individual. And I'm going to explain that right now. Credit cards. We've all gotten one, and we've all probably did something bad with one of them. If not, then financial literacy was something that was a part of your culture or upbringing, and your parents stressed the importance of a credit card, and you didn't have a bad or delinquent account with a credit company. These are the two things that people usually go through when growing up and turning 18 and acquiring their first credit card. My personal story was I got a secured credit card at 18. I then went into a deficit on my checking account of $170, and they took the $170 from the secured credit card funds, and I basically ended up forgetting about the credit card itself because I thought that that secured funds would go towards paying off the credit card and I'd have no issues. Well, TD basically took the remainder of the funds and then left a balance of $160, which I wasn't aware of. Why? Because I was living at a different apartment as to where my mail was going. So that's my story when it comes to my first credit card, and basically the only credit card I've ever had, and I haven't had one since. I do plan to acquire a credit card eventually again, because that has now been wiped off of my bureau because it happened to me when I was, I think, 18 or 19. So the importance of a credit card, and it comes to building your credit. The best advice I have for you, we can go into interest, we can go into detail about all these major things when it comes to credit cards, but generally the interest rates tend to stay the same among many other cards. It just depends on your credit. All right. If you have a secured card, that's completely different, but the interest rates tend to be a little bit higher. Why? Because secured cards are usually for people who have no credit or for people who are rebuilding their credit. All right. Best advice I have for you with a credit card: if you do have a credit card, there's absolutely no reason why you should have one but don't have the money that's actually on the card. That's the concept of a credit card. It's for emergency. It's not for when you want to go on a shopping spree and start buying stuff. That doesn't make sense. A credit card is there for emergency, and you always need to obviously be bringing in some form of income to ensure that you pay this card. Now, the difference between a credit card and a line of credit. Well, a credit card is usually for somebody who's looking to build their credit slowly, or just somebody who's looking for a method of secure, you can call them secure funds or security funds in case of emergency. A line of credit now is more for a business owner, for somebody who is going to be possibly taking cash from their credit. Credit cards usually charge you an X amount of dollars in order to take cash back, and will only limit you to a certain amount of cash back. Why? Because credit cards already limit you on how much they could actually give you in credit. A line of credit, on the other hand, can go upwards to sometimes even $20,000 to $30,000, and you're capable of taking an X amount of cash against that line of credit for a certain interest and a fee, obviously. But lines of credit tend to be in higher sums as opposed to a credit card. So just to recap, a line of credit is generally going to be, or in the best interest of a business owner and somebody who's going to be possibly wanting to access some form of cash at some point in time, and they usually have lower interest rates and have access, or give you access to a larger lump sum of money. A credit card, on the other hand, is usually, or secured credit card, usually for people who have no credit, post-bankruptcy, post-consumer proposal, or debt consolidation. Like I said, young people, anybody who's looking to either build their credit or have access to, let's say, a line of security funds. Usually the interest rates tend to be higher, and they don't allow you to take a cashback as much as a line of credit. Now, the last thing on the list that can make or break your credit history is a car finance. A car finance is probably one of the things that help your credit the most. Why? Because they report to the bank 4 times a year on how many payments you've been making and how well, and if you've been keeping up with the payments. A car finance can be very sticky. It's one of those things where usually, depending on your interest rate, it usually depends on your credit. So some people can pay as little as let's say a 2% or 1.5 interest to as much as a 33% interest on a car. It really depends on your credit. Car payments are something that, if you don't have a good job, I do not recommend you going out and financing a $20,000 to about a $40,000 car. It makes no sense. You're better off buying an old car and driving it to the ground and then buying a new car. At the end of the day, people always think about and weigh out the fact that they're going to have to either fix that old car, but at the end of the day, this new car can break down on you at any time as well. And knowing that you have payments to make on a depreciating asset is absolutely no fun. So I highly recommend that you do not take out a car finance unless you know you're in a position of where you feel solid in life and you can take on a continuous expense like this one. You'll be paying this thing for at least 6 years, depending on your credit history and the interest that you're charged. Why I recommend a car finance? Because they do report often. So this is in somebody's interest who, like I said, you've established a job and you feel comfortable with where you're at in life, and you want to start building your credit even further in order to either take out a mortgage, maybe take out a line of credit for a business, whatever it may be. A car finance really helps your credit and your credit score. But at the same time, like I said, it is an expense, and it is an expense on a depreciating asset. So be careful on what car you take out, how much it costs, and how long you're going to be paying it for. Those are the things you want to look at before you dive deep into something that you can possibly not be able to afford someday, and then now you have something on your hands that you're trying to get rid of, and it's, like I said, every single time you take that car off the lot, it's depreciating, right? Depreciating asset. So keep that in mind, guys. This was a Millennial Money Management episode 3. I covered the 3 things that are going to build your credit the fastest. Be careful with all 3 of them. Credit, credit card, line of credit, phone bill, and a car finance. I love you guys, and I will see you in episode 4 of Millennial Money Management. I haven't been able to think of a video idea yet, but you already know I'm always working hard to bring you guys good content, so that's going to be determined very soon. like, comment, and subscribe. Especially the like and especially the comment. If you don't like anything that I said in the video, I'd appreciate it if you dislike as well. God bless you, and I'll see you in the next video.